All right. Good morning. This is Jerry Muir. Robert, did you want to say anything before we get started?
The only thing I have is an update on the Lincoln Learn, and that is that the website says that it will be available on Monday, December 15th for certification tests. Other than that, we're good to go.
Okay, very good. And so then what we will do next week when we convene for our final session, with the Lincoln Learn being up on this coming Monday, then we will actually have a couple of exercises where we'll talk about Lincoln Learn and show you how to certify. Of course, we know the certification starts with the volunteer standards of conduct, and then you go through it sequentially. You would then go to the intake and interview, and then basic and advanced. All right, so today we are going to talk about the California updates, and we'll discuss. Basically, this will be California centric. And if you have any questions, you've got your moderators, but let's go ahead and jump into it. What we'll do for the last hour of the session, we're going to go through a scenario, and that scenario is going to include the Affordable Care Act, and then certain items as far as the California entries in the software. Okay, so we are going to talk about some forms. We'll talk about some various income items, certain deductions, and then there's a number of credits for California, similar to the federal government. And the credits that we are focused in on the VITA program will mostly be non-refundable, and there's a couple of refundable credits, but we'll talk about those. And then do keep in mind when you're talking about California credits, they are completely different from the federal ones because of the concept known as nonconformity. Okay, and there's a couple of changes. In fact, it most likely you'll probably see this at the VITA site. There's actually a change in California law for this tax year 2025, when it comes to military retirement. Now, when you have someone who retires from the military, whether it's active duty or reserve component, they're going to be issued a 1099-R as in Romeo. And we'll talk about the particular change, again, affecting California tax returns only. If you have someone who's retired from the military and you're preparing their federal return, it's the same as last year. Once that 1099 has been issued, that's going to be a fully taxable event. And then we'll talk about a couple of other things you may see at the VITA site. This is the Chiquita, I think that's Chiquita Canyon, and we'll talk about tax relief there. And then one of the big go-to documents for California is going to be the Franchise Tax Board publication 5130. And the 5130, California does a really good job preparing that, updating it, and it has all of the details that you need for California return preparation, to include contacts with the franchise tax board. And then, although you're not going to spend a lot of time in the FTB publication 1001, this is another go-to document because the state of California does not conform on certain issues, and we'll talk about some of those. And so, what that means is on the California return, there's certain income items that are not reported. And I guess a quick example right now, let's say you win the California lottery and you win $5,000 in the California lottery, fully taxable on your federal return, not taxed on your California return, and that's called a subtraction on your California return. So there's certain things that are again non-conforming, and your Pub 1001 discusses that. Thankfully, a lot of items are conforming, and so we don't have to make a lot of changes to the California return. And some of those non-conforming items are done automatically. And we've talked about that, for example, unemployment compensation and Social Security. You're going to enter that data on the federal side of the house, and it will carry over to the California return automatically. You don't have to make any changes or manual changes. Okay, and then this is a little busy here, but probably the focus would be that top item. You may get a question regarding California taxes, and your publication 5130 is going to answer probably most of those. but it's called a sitemap, and basically it's a landing page that has every piece of information you need to know for California, and it is voluminous. And that's called the sitemap, and that's a very, very top URL. I use that in my practice because sometimes I get a question from a client and I simply don't know. And so if I don't know that, I'll go straight to the sitemap, and that's probably a good reference that you may have to go to from time to time. And then a lot of times your taxpayer wants to have a little bit of taxpayer education. And so going to these websites, excuse me, these URLs might be helpful to your clients. Okay, and then there's a lot of updates, and you probably have learned by now there are updates not once a year, but multiple times during the year, not only on the federal tax, but also on California tax. And so when you're talking about California, probably one of the big changes, don't know if you're going to see a lot of this, but you have what is called the Chiquita Canyon. Chiquita Canyon, just FYI, it's an area. It was a landfill in Los Angeles County, and there was, I believe, methane gas, some other gases that were released. But anyway, it was a bad scene for individuals living in that area. So what happened is there was litigation, and then what happened is these homeowners near this landfill, they received payments, and those payments that they receive for, I guess, maybe health issues, they are excluded on your California return. Now, if you're thinking, what about the federal return? Well, there has been legislation introduced in Congress regarding excluding that, but at present, there's no exclusion for the so-called Chiquita Canyon payments. It's just for California. And so you may see that someone perhaps maybe sold their home, got a payment from the folks at Chiquita Canyon. And again, that's all excluded from your California return. And then the FTB has a website. It's a great place to go. You have all your forms, all your publications, all your notices, and it has information pertaining to filing, just about everything you need to know. That website has been extensively redesigned, and so if you haven't jumped on that website recently, you'll see the changes or redesign that started a couple 2 or 3 months ago. Okay, a few other things. When you hear the term conformity, and this is something you don't have to be an expert on, but you may get a question by your taxpayer at the VITA site, and they'll say, why does the federal government tax something, i.e., an item of income, and the California state government does not? And the answer is very simple. It's called conformity, which means the state of California is going to do what they're going to do, and that would be under the Revenue and Taxation Code for California. And so that's probably the quick answer to your clients, because sometimes you're going to get that. And so there's a lot of changes with California. California does conform to a lot of the federal government Internal Revenue Code, if you will, the tax law. And so there were changes made recently. And then this is one change, and I have seen this at the VITA site. You will not see it a lot, but you will see it when you'll have individuals who are paying or receiving alimony. And so on your federal return, if you're, let's say you got divorced 10 years ago and the individual that you have in front of you has paid alimony, they can deduct that alimony that they pay on their federal return. If you've received alimony, and let's say you got divorced 10 years ago, then that receipt of alimony is a taxable event on your federal return. We'll talk about California in just a moment. And so what California did, they made changes to the what is called the Schedule CA to conform with the federal law. Because under federal law, or your forms, I should say, you have to report the individual's name and you have to report the individual's social security number who is receiving alimony, i.e., you're paying it, which means you're taking a deduction under the old rules. And it starts to get a little involved, but we're going to break it down because there are old rules, there are current rules, and there are new rules for alimony received and alimony paid. We'll break that down during this presentation. But again, the form has changed, and you'll see that for tax year 20, excuse me, tax year 2025. Okay, so let's talk about the standard deduction. Thankfully, the standard deduction is something that is built into the software, so you don't have to calculate it. This changes every year, and we know in the VITA program, we do not prepare married filing separate returns. And we've mentioned this before, and sometimes you're going to have a client who's going to say, well, in fact, I had someone the other day said, I'm going to get divorced. I'm saying, well, I'm sorry to hear that. But as far as filing separately, we don't do that in VITA. And so when someone wants a separate return, probably the best answer is you tell them that we don't do that. And they're going to have to go out in town and find a paid preparer. And paid preparers, they prepare separate returns all the time. And usually the situation is someone is going through a divorce and they've made a determination in their mind they don't want to file jointly with their spouse because they probably are aware of the joint and several liability situation when you file jointly. So when you do file a joint return, you're on the hook for the taxes both as an individual and jointly with your, in some cases, obviously your former spouses when you get divorced. But again, we don't do married filing separate. And so as far as the standard deduction for the other filing statuses, you can see that amount there. It's 11,412. And so what does happen is your itemized deductions on your federal side of the house, that means sometimes you do itemize on the California return, but not necessarily. You could have an itemized deduction on your federal return and a standard deduction on your state return. Now, thankfully, your software is going to calculate this, and so something not to worry about. But again, this is these standard deductions amount are built into the California return. And then you will see this also every once in a while. It's called the Registered Domestic Partner, and that's RDP. And so when you have someone who's an RDP, what that means is they're living with someone. It could be a man and a woman. It could be two men. It could be two women, and they have registered with the California Secretary of State. And once they've registered and they meet the qualification, then they're designated RDP, and that's a filing status that's specific for California. And so as you can see here, married filing joint or RDP, the standard deduction is at 11,412. Now, on your federal return, there's no such thing as an RDP. And so if you are not married on your federal return, then you're not going to be filing married filing joint. And of course, the definition of marriage, you typically don't run into this. I've seen it a few times, but that means someone has been married somewhere in the world. And of course, then they come to your VITA site and they are married somewhere in the world, whether they get married in a church in France or they get married by a justice of the peace in Orange County, whatever the case is. If they're married, they're married. And again, that's usually not an issue you see, but when you do see it, then you have to explain to the individual in order to claim the married filing joint status, well, you got to be married and you got to be married in a jurisdiction. And so that could be in Mexico, it could be in South America, wherever it is. Of course, when you do get married in a foreign country and then you move to the United States, you're married. All right, so that takes care of our standard deduction, again, built into the software. So this is not something you really have to memorize. And then this is another thing that you'll see once in a while. You've got individuals that live in an area in California, and there's some type of disaster through wildfire. And this is something that affects, it's pretty tragic when you hear about it. Usually a home is burned down, people have been displaced. And then what has happened under California law, if a taxpayer receives a wildfire disaster settlement, and that would be like through the utility company because of negligence, for California purposes on their California return, it's going to be excluded. So this is one of those non-conformity that you may see. And so if you have something like this, the client will come to the site, they'll say, I've received some settlement, could be through mediation, arbitration, or a lawsuit. And then if it's for a wildfire, then of course on your California return, it's not a taxable event. And then at the very bottom of the screen, it talks about an amended return. Now, this is something that if you are amending returns, and this is really up to the site coordinator at St. Killian's, some sites will prepare amended returns, others will not. Usually during the season, there's a focus on preparing current year. So, for example, the site that I run, we usually don't prepare amended returns early on. We'll do that later on in the season and we'll announce it. But again, for amended returns, that's when you have a situation where typically you want to report a credit or a deduction that you're entitled to, and that's obviously going to generate a refund. And then usually when you amend a return, both the federal and the state are amended. But again, that's up to the sites. It's not a requirement in the VITA program to amend returns. It's just an additional service, if you will. Okay, and this is that Chiquita Canyon, and no, it's not the banana thing, it's the landfill. And in this particular case, individuals have received those settlements either through mediation, arbitration, or a lawsuit. And this income, if you will, it's non-taxable on their California return. So again, people would receive these payments because they had some type of usually a health issue, and this is also again non-taxable on the California return. And same concept, there's a possibility of an individual filing a California return and then receiving one of these payments and say, wait a second, this is non-taxable. And so the possibility of amended return. And I'm the first to admit an amended return is not a difficult thing to do, but it does take a little bit of training. And so I'll just give you my example. I operate a site at Coastline College in Garden Grove, and our folks who prepare amended returns are usually the senior ones that have some experience preparing amended returns. Okay, so this is something that will affect your taxpayers. I've seen this a number of times where individuals come to your site and they say, "Hey, I'm retired from the military." They might be 45 or 50 years old. They're working in a job and they're receiving military retirement. And you don't have to have your military certification in VITA to prepare a tax return with a military retirement. So when someone retires from the military, again, active duty or reserve component, they're going to be issued an IRS form 1099-R. And then when they come to the site, you'll say, okay, you're a military retiree. Gotcha. And then on their California return, under current tax law, that individual can exclude up to $20,000. So this is quite a deal for California returns. You cannot exclude it from your federal return. Military retirements are fully taxable on a federal return. And so this is something when you do see it, again, you can take an exclusion or a subtraction, if you will, on the California return. And then sometimes you might have someone who's a what is called a surviving spouse. And so what that means is person retires from the military, they pass away, and then the surviving spouse, I think it's 55%. They get 55% of the retirement, so to speak, and that's surviving spouse. So either one, whether it's military retirement or surviving spouse, they can exclude, they being the taxpayer, up to 20,000 on their California return. And you can see that right now under California law, this is effective for tax year 2025. So you may actually see this. And then, of course, there is a phase out, something we don't worry about in the VITA program because we don't assist taxpayers that make usually over about $70,000. So again, the phase outs for again outside of the scope, if you will. But again, a great exclusion for those retirees. And at my site at Coastline College, we usually see military retirees maybe about a half a dozen times during the season. So this is going to be good news for them. Okay, and then of course the personal exemption, and the personal exemption is a good thing. It helps to offset the tax, if you will. And the personal exemption usually goes up every year for California, built into the software. You don't have to memorize it. And so you can see that for most of our single filers, it's going to be $153 for a personal exemption. And then for married filing joint, that's going to be 306. And so that's a nice little credit, if you will. On your federal return, there's no dollar amount associated with the personal exemption. That went away with the Tax Cuts and Jobs Act of 2017. And then, of course, at the VITA site, we see a lot of dependents, and those dependents, the exemption credit on the California return is 475. And so this is a good thing. These credits go up, and again, they help to I'll use the term offset the tax. Okay, and then this is something that is probably going to be a little frustrating at the VITA site, and to be perfectly frank, you're going to bump into situations where the taxpayer is going to be uh, they're going to ask questions, they're going to be a little frustrated, and so we've talked about this on the federal side of the house, the so-called no tax on tips, which of course there's a limit. No tax on overtime, of course, there's a limit. And the so-called no tax on car loan interest, which is basically a deduction, and there's a limit. And there's also the deduction for seniors, and there's a limit, it's 6,000. So everything is limited. So the bottom line is on the federal side of the house, these are good deductions that taxpayers can take. But California at present does not conform to these deductions. And so there will be changes. Now, of course, we're waiting for the California software to come out. And I'm going to conclude when the California software comes out, it's going to be an automatic change by the software. And so basically stay tuned. But again, you're going to get questions and you're going to have to tell the taxpayers California doesn't conform or agree to federal tax law on these particular topics. And so you get it on the federal side of the house, but not on your California return. And so that's the explanation that you can offer to your VITA clients. And what we are going to do today, we are going to show you again where to go for the no tax on tips, overtime, and the car loan interest. Okay, and then of course in California, there's a number of credits. We're going to focus on the credits that you're probably going to see, and then we'll do a quick intro to some of the credits that you may be asked about. But these are really the credits that you're going to see on a VITA return. And so when you're talking about the earned income tax credit, this is similar, but there are differences because of the conformity issue. But a lot of our VITA clients do receive the California Earned Income Tax Credit, and you'll see shortly that this is a pretty healthy credit. And then the Young Child Tax Credit, you see this a lot because you've got kids who are under 6, and so mom and dad can usually take advantage of that. Foster youth tax credit, you don't see that very often. I mean, there's plenty of foster kids out there, but you don't usually see this a lot at the VITA site. And then one credit you'll see a lot of because a lot of our clients are renters. They rent their house or their apartment. And this is the California non-refundable renters credit. And the federal government does not have a corresponding renters credit or a foster youth or a young child. They do, of course, the federal government does have a federal EITC. Okay, so this is the California EITC, and there's a lot of rules here. This has been around for a while. If you joined us last year, you probably saw this a number of times. And so this is available. Again, it's different than the federal one, but it's still a refundable credit, but you have to qualify on the California side of the house. So what will happen for some of your clients, they will qualify for the federal EITC because of their income, they're not going to qualify for the California EITC. And so when you get that question, and you probably will, then you're going to go right back to that concept of conformity, or you're going to say California law is different than the federal law. And that's why you don't get the California EITC because you're making too much money, if you will. And so a couple things to focus in on. You probably, again, won't see a lot of this, but when you do, then you want to be prepared for that explanation or what I call taxpayer education. And so we know on the federal side of the house, if you have a certain amount of investment income, even though you meet all the requirements for federal EITC, you can't get it because your investment income is too high. Well, the same concept for California, except California has a lower threshold for investment income. So when you hear the term investment income, you go back to one of our previous lessons, you think about what is called portfolio income or unearned income. And so investment income includes dividends, interest, your capital gains, and your capital gains distributions. And that's investment income. And so if your client has investment income and that investment income is over 4,814, they're not eligible for California EITC, even though they would have been. So that's one of those qualifiers, if you will. And of course, your software is going to do it automatically. But if you get the question, so for example, let's say someone came into the VITA site, they sold a little bit of stock and they had a capital gain of maybe $5,000 and they were a lower income individual and they would have qualified for California EITC. But that qualifier of investment income then disqualifies them for California EITC. So again, you may see that. And so there's other qualifiers for the California EITC. You have to be age 18, and that's different than the federal one. So you might have a young adult who is a wage earner, or you might have a young adult who is self-employed, and they meet all the qualifiers for California EITC, and they may receive a little bit. And then, of course, there's a form that's going to be generated, and that's 3514 in the PDF file that you're going to give or excuse me, the PDF document you're going to print out for the client. And that 3514 is specific to the California Earned Income Tax Credit. And then here's another thing, as it says on the screen toward the middle there. If you have a taxpayer who has a valid ITIN, and you're going to see that a lot in the VITA site. Certainly not with every taxpayer, but you'll see it enough. I think where we're at, we see it maybe about 30 times a season. You'll have an individual who is they're undocumented, and so they're going to come in with a letter from the IRS, an individual taxpayer identification number, and then we can assist them. And we do assist undocumented individuals. They come in and they have their documents, their W-2s, they have that ITIN letter from the IRS. We will prepare a tax return for them. And that's something that it's a great service because think about it. If you're undocumented, usually you're in an environment that's a little different than your host country. And so again, this is an opportunity to get your return completed. And a lot of undocumented individuals, they want to be compliant when it comes to taxation because keep in mind, when you're undocumented and you're living and working in the United States for a number of years, you meet what is called the substantial presence test, which means you're treated just like anyone else. You have to file the return if you have a filing requirement, which means you may have to pay some tax or you may end up getting a refund. And so that's why that ITIN is so important. So again, California has made a decision through their legislature to allow ITIN holders to receive the Cal EITC. And then, of course, there's other requirements that you have to have earned income. And you've heard that term before. Earned income is usually wages and self-employment. Unearned income or portfolio income is interest and dividends and capital gains and capital gains distributions. And then other rules for the Cal EITC, you can't use that filing separate. We only tell people we don't prepare the return if they want to file separately. We'll give them information, we'll educate them, but we're not going to prepare the return. That's outside of the scope. And I'll be the first to admit, preparing a married filing separate return in some cases is very easy to do. But again, we're not trained to do it, and we don't do it at the VITA site. Other rules, you have to live in California more than half of the tax year. And so this is another thing. A lot of people, contrary to popular belief, a lot of people move into California. You read the stories about a lot of people moving out of California, and that does happen, but a lot of people move into California for various reasons. And so if you've lived in a state and then you've moved into California and you've only been here for maybe 3 or 4 months out of the tax year, and you qualify for EITC on all these items that we're talking about, other than the residency requirement for more than half the year, you're ineligible for the EITC for California. And so again, you're probably going to, I get questions all the time at the VITA site, and they say, why don't I qualify? We'll go through all of the qualifications. We'll say you meet most of them, but you don't meet all of them, and you have to meet all of them to get the credit. Okay, so this is good news, and I'll be the first to say when I prepare a tax return, or one of my folks prepares a tax return for a low-income individual, and they're eligible for the maximum or near maximum Cal EITC, that's a huge benefit. It's refundable, and this is just California. And so I think I mentioned before, your low-income individuals, they may walk out of the VITA site with a federal EITC and a California EITC, and the total amount may be $9 or $10,000. So that's a big thing for taxpayers. And so that's why it's so popular, if you will, with the VITA sites, because individuals know if they qualify for both federal and state EITC, it's a very large refundable credit. And then it says on that second paragraph, it says the FTB may need to verify income or losses. And so what that means is the taxpayer may have a delayed refund, and that simply is giving the Franchise Tax Board additional time to verify it. Or in some cases, the taxpayer may get a letter. And so I'll just share, and Robert, you might want to jump in and discuss this also. But what happens is taxpayers may get a letter and come to the VITA site during the season, or they may call me as a site coordinator and say, "Hey, Jerry, I got this letter. What does it mean?" So I'll ask them to read the letter to me, or at least the first couple sentences. Is okay. That's a situation where the FTB is essentially looking into this. It's not like they're auditing you, but they're looking into it, and they're verifying your income. It could be through a W-2 or some other information before they give the refund to you. And that's going to happen. And so, Robert, I don't know if you want to jump in here, but have you seen that at St. Killian's last year?
We did have a couple people, I think, that came in and asked about that letter, about the
Okay.
refund pending
And
letter.
so when you get that, I mean, it's going to happen. And I'm of the opinion if you can help people, and I recognize our focus is tax preparation, but sometimes people will come in with letters, and if you have someone in the staff on the staff who can review the letter and maybe has some experiences, maybe as a tax practitioner, then you can give some guidance to the taxpayer. And as I said before, we don't advocate for the taxpayer, which means we're not going to call the FTB and discuss things with the FTB, but we'll share information what the taxpayer can do. And if you can minimize frustration, especially when it comes to taxation, your taxpayer is going to be very grateful because a lot of taxpayers, and think about it, like my mother, she was not English speaking. She came to the United States and she knew very little English. And it was very frustrating for her to learn everything, especially the English language. And so your non-English speaking individuals, you want to help them out because bottom line is they're up against a system that they either don't understand or they have a very limited knowledge. And so pointing the way, that's the term I use, pointing the way for individuals who need a little guidance. That's appropriate. And I do that at my VITA site all the time. I don't advocate, but I'll point the way and say this is something you want to consider. And then sometimes we sit them down, we open up the franchise tax board website, we show them the site map and say, this is what you need to do, this is where you need to go to get this issue resolved. And then, Robert, you may have been talking about the franchise tax board letter 4502. And this is where the taxpayer receives the letter, and they come out all the time. And I've seen this again and again, where the franchise tax board is looking for additional documentation. And so there's different ways to handle it. If your taxpayer comes in with that letter, then you're going to tell them, yes, the FTB wants additional information. You can typically provide that either through United States Postal Service, or if you're local, there's a franchise tax board office in the city of Santa Ana and you can make an appointment as a taxpayer and you can go there and you can share that information that the FTB is looking for to get that refund released. And again, it's frustrating when somebody gets a letter. I recall in years past, I would get a letter from the IRS and say, "Hey, we need an additional document before we release the refund." And so you send the document or you present it in an office and you get the refund. But this is going to happen. And so again, a little bit of taxpayer education. There's a way to handle it. And the franchise tax board has a chat feature. They have a telephone feature, and they have the obviously you can send documents in to Sacramento, or you can go to the IRS office. Excuse me, the franchise tax board office in Santa Ana. And I've been to that FTB office in Santa Ana, and it's staffed with FTB employees. They do examinations, they do customer service. And it's been my experience, the FTB is pretty responsive when there's an issue that needs to be addressed. And then I think we talked about this at the very bottom. It says beginning, this was last tax year, refunds where it says are not used to offset delinquent accounts except for non-payment of child support or family support. And so what that means is the franchise tax board, like most people, they take a dim view of individuals that are not meeting their financial obligations from the court, where they have to pay child support or family support. And so refunds will be issued, but again, if you haven't paid your child support, then your refund is going to be snagged, if you will. But again, a great credit, again, up to a little over $3,700. And you combine that with your federal, again, upwards of $9,000 and $10,000 for those individuals who are going to meet this refundable credit. Okay, the young child tax credit, and this is another credit that you're going to see again and again because a lot of our clients who have children, those children are young, under 6 years of age, and so they may qualify for this particular credit. And there is an income threshold. AGI, of course, that's the adjusted gross income. And keep in mind that AGI is the California AGI because this is a California credit. And so they have to be below that AGI. And then, of course, for tax year 2025, there's also a threshold for income, and that's listed on the screen there, a little over 35,000. And so again, this is for low, or I guess depending on your definition, low or moderate income taxpayers. Thankfully, it's done automatically, so you don't have to do a whole lot of thinking on this. And then the foster youth tax credit, this is something that you don't see very often, but when you do, and here's another example where you have a taxpayer, they may be a young adult, they may be 18, 19, or 20, they've been in the foster youth system for many years. And for lack of a better term, a lot of these young adults are at a disadvantage because they didn't have mom and dad in their life. And when you have mom and dad in your life, typically things are going to go a little bit easier. So this is a credit that California recognized that these young adults, they need to have this credit. They should have this credit to help them out. And you can see there's different qualifiers, and one of them is they were in foster care for a certain period of time. They're in between 18 and 25, so typically young adults, and they're eligible to claim California EITC. And so this is yet another credit for individuals. And I'll use the term disadvantaged because the foster youths, the youths that I've met in the past, they were at a disadvantage. Again, mom and dad was not in their life. They typically did not live in a neighborhood where they had brothers and sisters and mom and dad. So again, that's a disadvantage, and this kind of helps out a little bit, if you will. Okay, renter's credit, you're going to see renter's credit again and again and again because we have VITA clients who are low and moderate income. And yes, some of them do own their own home, especially your seniors. They may have owned their home for 40 years and they bought it when you could buy a home that was, maybe you could buy a home with a salary of maybe, 40 or $50,000, something like that. But a lot of our clients are renters. They rent apartments and they rent homes, or they might rent a room in a home. And so if they are renters and they have to meet certain requirements, they have to rent California property and they have to rent that property for at least 6 months. And of course, it's their principal residence. And so if they do that, then they're entitled to the renter's credit. There's some other rules too. For example, if they're living in tax exempt property, they're not going to be able to get the renter's credit. Thankfully, this is a credit where you just have to click it in the software, indicate that the individual's a renter, and then the software is going to calculate it automatically. And as you can see right here, this renter's credit, and this is another education factor, if you will, the renter's credit for a single individual, if your AGI is over that, let's say over $54,000 approximately, that means they're not going to get the renter's credit. And so you might be asked a question, why don't I get the renter's credit? Because I'm only making, let's say, maybe 54 or $55,000. And you tell them, well, under California law, because your California AGI is over that amount that appears on the screen, you're ineligible for the renter's credit. Now, thankfully for the married filing joint folks, it's going to be a little bit more than that. It's about $108,000. And so usually your married filing joint folks who rent are going to get the renter's credit. But again, you have to pay rent. And again, it could be an apartment, it could be a room, it could be a house. And it's not a huge credit, but something it helps out. And here's some other rules, and we'll talk about that shortly. But if you look at the bottom of the screen, the credit, which is a non-refundable credit, and when you hear the term non-refundable, it's a dollar for dollar reduction of the tax. And so the maximum is 120 for the married folks, head of household, qualifying surviving spouse, registered domestic partners, and then $60 for the single individuals. And of course, you've got to be paying rent on a California property. And so other requirements, of course, at the very top, you've got to be again a California resident. And we should really revisit the qualifications for preparing a return. We do not prepare tax returns for California non-residents, and we do not prepare tax returns for California part year residents. And that becomes a little frustrating because you're going to have taxpayers at your site. Like, for example, last year, I had taxpayers who had moved from New Mexico to California. I think I had some folks from Oklahoma and Kansas who moved from those states to California, and they wanted us to prepare a part year return. So we had to explain to them we do not prepare part year returns. And it's a little frustrating. So what you do is you say, well, you have a couple of options. One option is you can do it yourself, or you can go out in town and you can have a tax professional prepare your part year or your non-resident return. But again, we don't do those returns. And then, as I mentioned before, you pay rent at least 6 months for property that's in California. And then think of your principal residence. Your principal residence is, well, where you live. And so that could be a room. Let's say you're a low income individual, you're living in Orange County, and you got a job and you're happy with your work, but you cannot afford an apartment. Like in my area, I think some of the apartments go for $2,500 a month. That's pretty pricey. So maybe someone rents a room in a house, and that would be their principal residence. And so they could take advantage of the renter's credit. Okay, and so I think that takes care of that. Robert, I'm going to hesitate for a moment and see if anybody has any questions.
There are a few questions. First question is, when you speak about how much money the people are making, are you talking about their gross income or their income after deductions?
When you're talking about these California credits are typically based on adjusted gross income. And when you hear that term, when you look at your form, you're going to have your income less any adjustments, and then the difference would be AGI. But thankfully, this is going to be done automatically for you. And of course, when you hear the term income, then you have to differentiate whether it is income, AGI, taxable income. And so it depends. But again, for our credit purposes, you're talking about California AGI.
And for the renter's credit, can a taxpayer take the renter's credit if they're paying rent to their parents?
Sure. And when you, in fact, I've got a live example. Um, Although it's an old example, when I was a young man, a very young man, my dad sat me down. He's a great guy, and he says, "Jerry, you're making some very good income as a young man. You're going to start paying rent." And I did. I paid my dad a monthly rent. I think I started paying rent when I was 15 years old, and then I finally moved out when I was 18, and I paid rent for about 3 years to my dad. So yes, if you pay rent to your parents and that's your personal or your principal residence, sure, you can do that.
And then one final question it asks about the credit when someone has a dependent child, but someone, well, I'm not understanding. When someone has a dependent, not a child, but someone who sponsors, would the credit be refundable or non-refundable? And also, do they claim it on the federal or just the state?
Yeah, I think we're going to have to develop that fact pattern. When you hear the term sponsor, then we need to determine if it's a qualifying child, because we know for dependents, you either have a qualifying child or a qualifying relative. And when I hear the word sponsor, then I think about something else. So if we could have that individual kind of develop that fact pattern, then maybe we could tackle it next hour or maybe even next week. And Robert, you can catch all the details on that, and then I might even announce that next week.
Sounds good. That's all the questions we have for now.
Okay, great. All right. Let's see here. Let's continue. We got a little bit of time here. Now, I believe in tax-free education because I know I've been educated a lot in my life. This particular credit that appears, this particular credit, the only reason that you want to have an awareness of this is because of tax-free education. And this particular credit, known as the joint custody head of household, as you can see on the screen, you get this particular credit if you meet all the qualifiers, and it's used for married filing separate or RDP filing separate. And so if someone says, "Hey, this particular credit, what's all this about? I heard about it." You can tell your client, well, this credit is for folks who are married filing separate. We do not prepare a married filing separate return. So the credit is available to you, but you're going to have to go somewhere else to get this credit because we do not prepare, again, married filing separate returns in the California VITA program. Now you can go to other states, and other states will prepare a married filing separate, but not here in California, not in the VITA program. So again, this is a credit that is available. And then just more of the so-called joint custody head of household. I've had questions on this before, and I say, yeah, you don't see it very often because again, in my practice, my paying practice, I think I prepare maybe two or three married filing separate returns a year. And so again, just an awareness. And there's also a thing called the credit for dependent parent. And same concept. If you're married filing separate, you can get this credit. And so if someone brings this credit up to you, you can say, yes, it is a credit. It's a California credit. However, you have to file separately to get this credit for a dependent parent. So again, an awareness only. Okay, and then another credit that you may be familiar with, it's called the senior head of household. And you can get this if you're a senior, 65 or older, and you're claiming head of household for a certain period of time. And it also says your qualifying person passed away in the past 2 years. So this is something that you may see at the VITA site, but it is an active credit for California. And if you do qualify for it, then that means you can see at the very bottom there is there's a threshold, and you're not going to see that threshold in the VITA program because, again, we prepare returns typically for individuals making about $70,000 or less. But this credit does exist.
Question, it's about the renter's credit, and it says, do the parents have to claim the rental income for the child to claim the rental credit?
Well, I guess the best way to describe it, the child can claim if they meet all the qualifiers, if they're paying rent to the parents. But when you're talking about a parent who's receiving income from their child, that's called rental income. And so that's something that we would not assist the parents with unless you're certified on the military Lincoln Learn certification. The military certification, what we do is or what the IRS does, they train individuals on the rental income, and usually it's one property, and it has to be qualifying for the VITA program. So the short answer is we could do that in the VITA program if you're certified in the military. Bottom line is the taxpayer has to report it. And this is something I think I mentioned once or twice before. You probably will see things where people will come in and say, "Hey, I had this item of income." And when they share that item of income with you, for example, a settlement from a court decision, maybe a class action settlement, and maybe it's $500, or maybe you've got rental income. Mom and dad receive rental income from their child. Those are items of income typically, and the first thing you want to do, you want to determine is it taxable income, and if it's taxable income, it's reported on the return. So again, the short answer is the individuals who receive rental income, they would report it on their Schedule E as an echo on their federal return. And if you have people who are certified on military, then we would do that. And of course, they have to be within the vital limitations. And so if somebody came to my site at Coastline College and said, "Hey, Jerry, I'm a parent. I rent my rooms out to my adult kids. They pay me rent." And I said, "Okay, if you qualify, I've got military certified preparers. We can prepare a return." And then this is an important thing. We don't teach the concept of depreciation in the VITA program. So the individual, the taxpayer would have to come to the VITA site with the depreciation expense already calculated, because when you have rental property and you place it into service, you have to engage what is called cost recovery or depreciation. So again, they have to come to the site with the dollar amount of the depreciation expense. Long answer to a short question, Robert.
Very good.
Okay, and then again, more of an awareness. I think I've seen this a couple times at the Vita site, but then there's a couple of howevers. You might have an individual who says, "Hey, I paid tax to another state." Well, if you paid tax to another state, that means typically you filed a return or have to file a return with that other state. And we don't do that in the VITA program. So I'll give you a quick example. At one time, I paid income tax as a California resident. I paid income tax to the state of Colorado because I had rental property in Colorado. And so what I had to do is I had to prepare a Colorado return. I had to pay my Colorado income tax. I prepared a California return because I'm a resident of California. And then because I included my Colorado income on my California return, then to mitigate that, California has a other state tax credit. And so you might bump into this where someone's already filed their, let's say their Colorado or their New Mexico return, and they come to the site and say, "Hey, I don't expect you to prepare a New Mexico or Colorado return, but they're eligible for the other state credit." And this one is the Schedule S as in Sierra. Again, probably more of an awareness thing. You probably won't actually prepare a return like this, but that's what the credit's for, where it goes to mitigate paying tax to two states on the same income. and just more of the other state tax credit. I actually had this with a taxpayer who paid tax to a federal government, and she was not allowed to take the Schedule S's in Sierra. But again, more of a or just a taxpayer education. This is most likely a professional tax preparer. They're going to tackle this. Okay, let's get into alimony. You'll see this from time to time at the VITA site. And so what we want to do, we want to talk about the old rules, the current rules, and the upcoming soon-to-be new rules. And so we'll talk about federal and state. So if you go to the top of the screen, it talks about those divorces, and typically it's divorce. A separation agreement is something that is issued, legally separated, issued by the judge, but typically you'll have a divorce decree. So the old rules, these were for divorces that were signed on or before December 31st of 2018. The federal and the state, they both agreed with each other, which means alimony received was includable in income, which means you reported it on your tax return. And then alimony that was paid by taxpayers was deductible. And those were the old rules. And then what happened is you had the Tax Cuts and Jobs Act came out back in late 2017. And then this is where you had nonconformity. So the feds, this is in the middle portion of your screen, the feds said alimony for people who got divorced on or after January 1st, 2019, and through 2025. This is current. Uh, Federal government said alimony is not included in income, and you cannot deduct the alimony that you paid. So that's why it's important when someone says, I'm divorced. Okay, when did you get divorced? And if you're paying alimony or receiving alimony, it means something depending on when you got divorced. So again, the middle portion, this is where you have nonconformity. California said, hey, we're sticking with the old rules. You've got to report your income that you receive, your alimony income on your California return, and you can deduct your alimony that you paid on your California return. And so again, you've got to get the divorce date, you've got to get the name of the former spouse, and you've got to get the social security number of the former spouse. And so those are the current rules for tax year 2025. Now, if you join the VITA site in tax year 2026, you're backed to conformity, both federal and state. And this would be for someone who got divorced after December 31st of this year. And what that means is alimony is not going to be included and alimony paid is not going to be deductible. But again, for current year, for those people who got divorced during that time frame, during that middle paragraph, for California, your alimony is included. And typically alimony in the VITA site I've seen, the most I've ever seen, I think, is maybe a couple $1,000s a month. Usually with low income, moderate income folks, you're not talking about, 4 or 5 thousand a month. Usually it's 1 or 2 thousand a month. And as we mentioned before, you have to differentiate between alimony and child support. And even though the divorce decree may use the term family maintenance or family separation or whatever, you as an individual VITA preparer, you have to differentiate between alimony and child support. And you do not need to be an attorney to calculate this, to review a court document. I reviewed thousands of court documents. I'm not an attorney, and it's going to be self-explanatory. And sometimes you'll ask the client, "Hey, client, the term family maintenance is used here. So explain to me how much money is going to the adult, i.e., typically the former spouse, and how much money is going to the typically minor children." Minor children support is child support. Support for that adult is going to be alimony. And keep in mind, it has to be an order by the court, which means a judicial officer, i.e., a judge or a magistrate, who has the authority to issue such an order. And I bumped at that from time to time. I had one case, a VITA guy, he was giving money to his former spouse. And I said, okay, well, what kind of court order do you have? He goes, I don't have one. I'm doing it because Even though I couldn't get along with my former spouse, I want her to be, financially secure. I want to be able to pay her bills. I said, okay, I'm that. But you've just painted a picture of you giving a gift to your former spouse, and that is not alimony. So that means in your particular case, you cannot take a deduction on your California return because it's a gift. And when you hear the term gift, that means you're giving people money, and people give people money all the time, or it could be property, and you expect nothing in return. And that's called a bona fide gift. So again, alimony, rely on that court uh, instrument, or sometimes the individual will not have the divorce decree, which means you're gonna talk to them and they're gonna explain to you, this is what I'm receiving from my former spouse, and this is alimony ordered by a judge. Okay, Robert, I've got a little after 10 o'clock. Any questions, or this is a good time to take a break?
We have no questions, and I think this is a good time to take a break.
Okay, very good. Let's come back in 10. And Robert, I am back when you're ready to go. I think we got another minute or two.
All right, let's just give everybody another 2 minutes and then we'll get going. And then there's a question they're asking, are we going to revisit last week's step up in cost basis topic?
Let's see. The short answer is no. If we need to bring up a slide regarding step up in basis, I've got one uh, in on my computer. I can bring that up. Did they want to revisit that?
That's what it says. It says, are we going to revisit last week's step up in cost basis topic?
Sure. What we'll do is after we take another break here, I'll bring that PowerPoint up and we'll show I think it's a one or two slides that I have regarding step up in basis.
Very good.
All right.
There's one follow-up question on the renter's credit, and it's saying if the client tells you that their parent isn't going to claim the rent that they're paying them, can they still claim the credit?
Yes, they can because that's two different situations. One, you have a individual who's paying rent for his or her personal residence. And then the other situation you have taxpayers who are not claiming income that they should. So two different situations. So probably the taxpayer education that's involved here is letting them know that their parents have an obligation to report rental income on the parent's return.
Very well, that's all we have for today. If you want to expand your screen, we'll be good to go.
Okay, very good. Okay, let's jump into some more California topics here, and we'll talk about dividends and there might be individuals that you bump into your clients, and maybe they don't have a clear understanding of dividends. Dividends, of course, are paid by corporations. And when you are paid dividends, that means you are a shareholder or a stockholder in that corporation. And then, of course, you might have a situation where you are a shareholder in a mutual fund company, which is a corporation. And then what happens is you're paid dividends by the mutual fund company or corporation, and they're still going to be generally dividends are going to be reported on your federal and your California return. But then there is an exception for California. This is those one of those nonconformity type rules. And this is at the very top, California is not going to tax dividends paid by a mutual fund when the interest is received from a U.S. obligation like a treasury bond or a treasury note, something like that, or a California bond or a municipal obligation. And of course, the rule is at least 50% of the fund's asset has to be exempt. And so, for example, I think about a month ago, I don't know why, but I did. I bought a California uh, municipal obligation, and so I put money into it. I'm going to be paid interest on that. And then what's going to happen is when I file my California return, I'm not going to report those dividends or the interest on my California return. On my federal return, I will. But you may see this, and this is really important. Now it starts to get a little bit involved. Individuals will come to the VITA site with an IRS form 1099 uh, B as in Bravo. And that's going to be from their brokerage house, from their broker. And the 1099B, a lot of them are going to be short documents, maybe 2 or 3 pages. Some may be maybe 15, 20 pages. But the 1099B is going to report interest, typically dividends. It'll have capital gains distributions. And then as you go through the document, it will show the tax exempt interest as far as California. And you may have to go toward the back of the 1099B, but you're going to see that. And then another thing, which we're going to talk about shortly, in your 1099B, it'll also show the amount of the investment expense. So, for example, I've got a broker, Edward Jones, and they charge me for managing my portfolio, one of my portfolios. And so, in the very back of my 1099B, it has portfolio expense or investment expense. That's not deducted on a federal return, but it can be deducted on a California when you itemize on a California return. And so again, the 1099B is going to be one of your go-to documents to get the information pertaining to dividends that are not deducted, excuse me, that are not claimed on a California return. And then this is something I remember the first time I heard about Indian tribal income. I didn't really think much about it. Said, well, I'm not going to apply. I probably won't see it. And sure enough, I saw it at a VITA site. And so we're going to just talk about some real basic rules when you talk about Indian tribal income. You have individuals who are enrolled in a Native American tribe, and that's the term. They have to be, it's called a blood quantum. They have to have a certain amount of their blood, if you will, their makeup. And the tribe then says, okay, if you have this blood quantum, you can enroll in the tribe. And then you have federal recognition, and then you have state recognition. And so when you talk about tribal income, as it says on the screen here, if you receive earned income, it may be exempt on your California return. Your earned income, i.e., your wages, your W-2 wages, are not going to be exempted on your federal return, but it can be exempted on your California return. And so you have to meet certain requirements to exempt earned income. And as it says on the screen, the middle paragraph, when you hear the term earned income, your wages, you may hear the term salary or commissions. It's all going to be run on the W-2. But again, earned income. And so again, if you have earned income and you meet certain requirements, you do not have to report that earned income on your California return. And so here are the examples. You have to be an enrolled member, as we mentioned, and it has to be a federally recognized California tribe. There are tribes in California, last time I looked, they have both federal and there are some state recognized tribes. And then, of course, you also have to meet this qualifier. You have to live in what they call Indian country. Indian country, there's different terms for it. You may have familiar with the term reservation, but again, you're living on tribal lands. And then you have earned income, and that's evidenced by a W-2. And it doesn't matter who you're working for. If you meet these requirements, then you do not have to report that earned income, or stated differently, it's exempt from California tax if you meet all these requirements. Not federal income tax, but California tax. And again, earned income. And you have to differentiate between earned income and a per capita payment. And we'll talk about per capita here in just a moment. Okay, so when you talk about per capita, probably one of the best examples I can think of years ago, I was talking to someone who is a member of I think it's called the Pala tribe, Pala, down in San Diego County. And if you've ever been there, they do have obviously business interest on tribal land. And one of them, they have a very, I've been there a couple, 3 or 4 times. They got a real nice casino. They have all the restaurants and they have all the games down there. And then what happens is the enrolled members who qualify under the tribe, they receive a per capita payment and they don't have to work at the casino at the business. They just happen to be a member of the tribe and they enjoy essentially a portion of the profits. And that's called a per capita payment. Well, per capita payments, you can exclude them from California taxes if you meet certain requirements. First of all, you have to be enrolled in that particular tribe, and then you have to receive what is called sourced income from that particular tribe. So you have to meet certain rules, and then you have to live on tribal lands. So you might have someone who's living on tribal lands and they'll come up to a site because of whatever reason. Maybe they went to college in that city and they go, "Hey, I've got tribal income." Then you have to differentiate between W-2 and per capita payments. Some of the tribes in California, I went to one Indian tribal land one time, and they had a very small business. I think it was an orange orchard. They did not have a casino. And so, for lack of a better term, they were one of the poorer tribes. Well, in that particular case, they still had per capita payments, small per capita payments for their enrolled members. And if the enrolled member met all of the requirements, i.e., they lived on land and they had sourced income, then that per capita payment was not taxed on their California return. And so when you have someone who identifies as a Native American and they're enrolled in the tribe, then you're going to differentiate again between W-2 and per capita. And enrollment is really important. If you're a tribal member, you know whether or not you're enrolled or not. And then to kind of take it a little bit further, sometimes you'll have a tribal member who is enrolled, and then for whatever reason, they're disenrolled. So it becomes a little bit of a workout, if you will. But again, your taxpayer, if they are a tribal member, they know they're a tribal member in good standing, and they know that they either have per capita, W-2, or both. And then you can differentiate. And again, if they meet all the rules on their California return, their W-2s and the per capita are not taxed. And then this is something you see in the tax code, both the federal tax code and the state tax code. You see what are called special populations. And I think we've mentioned this before. Special populations include disabled individuals. It includes seniors. It includes military members. It includes individuals who are visually impaired, who are blind. And so special provisions or special populations, they enjoy, if you will, they enjoy certain types of exemptions and certain types of deductions. So you're going to see this again and again. All right. Okay, I know that's a lot, but again, if you see it, it's not difficult to tackle. And then if you don't want to tackle it, go to your site coordinator. And then Robert, you got my phone number, and if something pops up at your site and you need some information, I can help you out with that if you have a tribal member.
I have a question on that. And
Okay.
is the per capita income reported on a 1099?
The per capita income that I've seen in the past was reported on the 1099. And when this is really important, if someone says I've received per capita payments and they don't have a 1099, then what you want to do, you want to determine how much it is. And if they meet all the rules, you can exclude that on your California return. And we've mentioned before, sometimes you're going to have a payment and the individual does not have what we call an information return evidencing that payment. And so it simply means you're going to ask a few questions. How much was it? What's the nature of the payment? And then if you determine it's taxable, then you're going to put it on the federal return. If it's exempt, then of course, then you're going to subtract that from your California return. Anything else, Robert?
Nope, that's it. That was the only question on that topic.
Okay, then let's get into a couple of items that you may be asked about. And this is good information. Again, you're sharing information, you're educating your taxpayers. And so one item is the filing due date. And this is the general rule. I think we mentioned before, there are all sorts of exceptions, but generally in the VITA program, our clients want their return completed, and certainly they want to file by the 15th because most people know filing by the 15th, you avoid penalties and interest if you owe money. And we know that the filing due date for the state of California for our current year is going to be April 15th. Same thing for the federal return. And the important thing is if the taxpayer does not file by the 15th, Of course, there's what is called a automatic extension for California. But if they don't file by the 15th and they owe money, then they're subject to penalties and interest. And yes, California does have a one-time abatement, but the bottom line is if the client knows that they owe, if they want to, at a minimum, they want to pay what they owe. They can file later because they're, again, the automatic extension, but they want to pay what they owe. Most of the taxpayers who come to our site, we're going to prepare the return for them. They're going to sign that 8879, both federal and state, and then we're going to go ahead and file their return. But there is, again, an extension, and that extension for California is paperless. And the federal government is different, but California is paperless. But again, the focus is, the mantra is make sure the taxpayer is aware they should pay what they owe to California if they owe by the 15th of April. And of course, there are other extenuating circumstances, but again, that's the mantra. Just pay what you owe. This is something that I see from time to time. I see taxpayers telling me they're leaving, or maybe their mother or father left the United States and they're going to be traveling. They're going to be away. I've got a lot of clients who go to other countries for 3 or 4 months at a time, and that's the country they grew up in. So if you have someone who's overseas, then on their California return, again, they're still required to pay what they owe by the 15th of April, but they don't have to file on the 15th of April. So there's extensions, and those extensions can go all the way to December 15th. For VITA purposes, since usually we shut down just before the 15th, we have to tell the taxpayer, pay what you owe. And then if you have to file a return later, we're not going to be here. Our staff's going to be gone. The site's going to be closed. So, and this is important. And I don't know if Ashley's still on the call, but the Orange County United Way, there are certain sites in Orange County that stay open past the April 15th deadline. And that's where you want to find one of those sites that is open where you can get your return completed. But again, the takeaway is pay what you owe by the 15th, which means you've got to calculate what you think you owe and make sure you pay. And usually you pay online or you can write a check to the state of California. Okay, and then filing status, and I'll just kind of focus in on the very bottom of the screen. We do not prepare married filing separate MFS returns in VITA. Non-negotiable, we don't do it. And you're going to get people pleading with you. And it's a sad story because people go through divorce. It's a very emotional time financially. It's usually devastating, but we don't prepare married filing separate. If the client needs that, then you can refer them to the uh, the clinic that we talked about in the city of Santa Ana, or you can go to a professional tax preparer. And professional tax preparers, they do this all the time. This is not a bridge too far. Now, keeping that in mind, then this is just more of an education thing. Sometimes you have someone who files a joint return on their federal side of the house, meaning married filing joint, and maybe they want to file separately for California. Well, they can do what they want. I mean, if they meet the requirements, but we don't file a separate California return. So we can share information with them. Yes, you can do that. But again, you'll have to go to a low income tax clinic or you're going to have to go to a paid professional to get your California return filed separately. But you may see this from time to time.
Jerry, do we help people file extensions on the federal side if they come to the site on the last day and don't have all their paperwork?
Robert, typically we do not. Have we done that in the past? I'm sure maybe we have. Generally, no, you're not going to do that because filing an extension, it may be easy to do, but you still have to have a little bit of training to actually do that. So the short answer is no, we don't file extensions. Now, what I do on my site, I do the best I can. I try to educate clients. I don't want a client to come to the site having lots of questions and then not giving them at least, pointing the way. So I'll usually say, this is the requirement, and this is where you go to file your extension, and then I'll educate them. But no, we don't file extensions for them. And the same thing with powers of attorney. A lot of clients want a power of attorney. We don't file a power of attorney for them, but we will show them the way. I'll show them the website, and I'll tell them, if you need a power of attorney for whatever reason, you might need a federal and or state power of attorney. And so I kind of point the way to them and say, this is what you can do on your own. If you don't feel comfortable, then you have options: the low income tax clinic in Santa Ana, or you can go to a paid professional. But yeah, there's a lot of things in VITA tempting to do, but we don't want to do that because we're not trained.
That's all I have for now.
Okay. All right. Let's go into a couple other topics. The kitty tax. This is something that, as far as California, there's a couple of forms, the FTB forms, but usually you don't have to make any entries. And kitty tax is this: you have an individual, and this is usually going to be a young adult, and that young adult has unearned income, and this applies to unearned income. And if you have earned income, W-2 wages, self-employment, that is not a kitty tax situation. If you have earned income as a young adult and you have a filing requirement, you file your own return. And that's called the assignment of income doctrine, which means the kid has a filing requirement for earned income. Parents may have their own filing requirement. But the assignment of income doctrine states that you're not going to bunch up income on the same return. And there is an exception to that, and the exception is kitty tax. And so for kitty tax, usually it's going to be a young adult. They've got unearned income from maybe a bank account, or dividend income from maybe some stocks that they own. And of course, if they're a youngster, then usually they're going to be on that account with mom or dad. But in this particular case, this California kitty tax, basically it mirrors the federal one. This will be taken care of automatically in your software. But again, if you have a situation where you have earned income, then that child has to file their own return. And a lot of times people say, well, what if the kid's like 10 or 12 years old and they've got earned income? Well, if they have a filing requirement, or they choose to file a return, maybe to get a refund, then they're gonna have their own return. And of course, we know if you have a child, the child doesn't have the ability to engage in a contract. That's our society. We said kids don't have the ability to sign contracts. And so what that means is the child is not going to sign the return. The parent will sign, or the guardian will sign the return for that child that has earned income. And for unearned income, the parents can claim it on their return if they choose to. But again, you're going to enter that data for the on the federal side of the house, and it'll basically roll over to the state of California. And I think I mentioned before, we had at the VITA site, we had a woman come in who had a couple, two or three children, and the children were receiving Social Security, and mom was receiving earned income and some Social Security, and our volunteer wanted to bunch up all of the Social Security and I think some earned income on mom's return. And we said, no, that violates the assignment of income doctrine. You have to keep it separate. And the exception again being the kitty tax, where you add that unearned income to the parent's return. Okay, itemized deductions, and hopefully next week we'll have that 2025 California return. We'll have an example or two on that. But when you hear the term itemized deductions, these are the Schedule A itemized deductions that you see on a federal return. California also has itemized deductions, which are similar but not identical to the federal. And so, as it says on the screen, California does not conform to the suspension of miscellaneous itemized deductions. So there's certain things that you can take on California itemized form as opposed to the federal itemized. Now, of course, in the software right now, the 2024 software is the one that's available for California. You would jump into the federal side of the house and enter certain itemized deductions on the federal page, and they roll over to the state of California. So let's talk about some things that you may see on a California itemized deduction. One example could be unreimbursed employee expenses. And so when you hear that term, it simply means you've got a W-2 employee and they are incurring or paying expenses on behalf of their employer and they're not being reimbursed. And so when I was an employee, I worked for a bank before I joined the IRS. And the bank said, Jerry, every day we actually received, we were a small bank, if you will, and we received deposits. And then every day we would take checks and currency to a large bank and make a deposit. And I was reimbursed for my travel. But of course, when I added up all my expenses, my reimbursement sometimes did not cover all my expenses. So therefore, I was incurring expenses on behalf of my employer, and I was not being fully reimbursed. In that example, I could take an unreimbursed employee expense on my California return. Tax prep fees, even though we don't charge tax prep fees, you might have someone who's new to the VITA site and maybe they paid their practitioner $400 or $500 last year. And then they say, hey, I paid this in 2025 for tax year 2024. That tax prep fee would go on their California itemized deductions. And then other things that's very popular, safe deposit boxes, keeping wills, I remember when I had a safe deposit box, I was an investor when I was a youngster, and I had gold bullion and I had silver bullion along with some other things. And so that safe deposit box, that's something you can deduct on your California return. And then sometimes investment expenses, you're going to see this a lot where someone has and I grant you, it might be a small portfolio, and they have someone managing it, Fidelity or Edward Jones or Charles Schwab, something like that. And the taxpayer is paying some type of investment expense. It might be a portfolio fee of 1%. It might be a flat fee. Those particular fees can be deducted on a California return. And as I mentioned before, the 1099B, B is in Bravo, that's going to be your go-to document typically for investment expenses. And usually you're going to have to go toward the end of that document to see this is the investment fee that's being paid. And I've seen this on VITA returns upwards of about maybe $1,700 for a portfolio. And keep in mind, in VITA, you can have a net worth of 500,000 or $1 million. I've seen that before in VITA, but it's all based on income, not net worth. And so that's where you would find that investment fee again on the 1099B as in Bravo. Again, all of these are California itemized deductions. Okay, and this is just kind of nice to know because you might get a question, and again, taxpayer education is important. And when you show someone something on the IRS website or Franchise Tax Board website, it's just all part of education. You're not engaged in tax planning, but you're just showing them information. So this is a question you're going to get again and again and again. They're going to say, hey, I owe tax to the state of California. I owe tax to the federal government. And when they say that, they're going to ask you how how many years do I have to worry about this for? Well, for California, you got to worry about it for a long, long time. When there is an assessment under the California Revenue and Taxation Code, the state of California has 20 years to collect that assessment. And that's a long time. And so I always tell people if you owe tax to the state of California, you want to pay it. You want to pay it as quickly as you can because there's penalties and interest. And I recognize some people can't afford to pay it, but the bottom line is that that debt is going to hang over that person's head for 20 years. And then this is another question you get. You get questions, hey, how long do I have to keep my records? Well, you have to keep your records generally for the federal side of the house, 3 years, but there's all sorts of exceptions. For California, you got to keep your records minimum for 4 years. And then when you talk about the assessment, the additional assessment, which means maybe you've got the franchise tax board, they audit someone, and they've got 4 years. They be in California, they got 4 years to make an additional assessment. And of course, there's exceptions to that too. The term notice of deficiency, we don't worry about that in VITA. We don't issue them, and when someone has one, all we'll do is just share information with them. A notice of deficiency, whether it's a federal government statutory notice of deficiency or a California one, it simply means the feds or the state have issued this particular document to the taxpayer saying the taxpayer, they have an assessment that's going to be going against them. And then, of course, the next step is collections. And so when you get a notice of deficiency with my paying clients, when they receive one, or I've seen it at the VITA site, I'll read it and I'll say, okay, this is what it is. And you have options. Then we go to the website and we educate the taxpayer on the notice of deficiency. And the bottom line is don't ignore it, because when you get a letter from the government wants to do something, they want you to do something. They'll usually use the words shall, will, or must. And when you have that language, that means you have to take some action. But again, educate the taxpayer. Do not advocate for them. Do not say, "Hey, I'll call the franchise tax board. We'll handle this." No, that's beyond the scope. That's something the taxpayers are going to do, or a paid representative or the low income tax clinic will do. And I think that's about all we need to discuss on California nonconformity when it comes to collecting taxes. And this is a sore subject with a lot of individuals because they have an assessment from previous years and they obviously are trying to pay it. There's interest and there's penalties. And they're going to ask you, how long do we have to worry about this? And a long time. Now, for the federal side of the house, the collection statute expiration date, this is the general rule. It's 10 years. So anyway, the feds and or the state, they get a long time to collect that.
Jerry, I have a clarification question. What does 2% AGI limitation mean?
Oh, the 2% AGI limitation, what that means is, and these were the old rules on the federal return, 2% of your adjusted gross income before you could take a miscellaneous deduction, or most miscellaneous deductions, you had to subtract 2% of your adjusted gross income. And so probably trying to think of a quick example here. So let's say you had unreimbursed employee expenses of, I'm going to do this in my head, let's say $1,000. Before you could take that $1,000 deduction on your federal Schedule A, you had to subtract 2% of your AGI. So if your AGI was, I'll just use an example, $100,000, well, 2% of that is 2,000. Well, that means based on that fact pattern, you're not allowed unreimbursed employee expenses because that 2% AGI eliminates that. So yeah, that's what that means.
All right. And then also, just to clarify, the on the 1095, 1099B investment income, you said it was deductible in California, but not deductible on federal taxes. Is that correct?
That's correct. Your portfolio fees, your investment expenses that are charged by your broker, yes, deducted on California, not on your federal return.
Okay, that's all I have.
All right, great. Okay, some more nice to know taxpayer education, as I call it. A lot of times, and I've seen this before too, a taxpayer will come up with a California notice of proposed assessment. I remember a lady came to me. She was a hairdresser, and she had her. I think the term is called um, cosmetology. I think that's the term. So she was a hairdresser. She went to hairdressing school, cosmetology school, and she was licensed. And then she did not file a return, a California return for 1 year. And she came to me with this notice and she goes, jury, the state of California says I most likely made whatever $70,000 in this year. I got this notice and they're proposing tax. I said, okay, well, then what happened in that year? Why did you not file? And she had some type of medical issue. She said she was out of the picture as far as earning income. She still held her current license, but California said, hey, this is a proposed assessment. I said, okay, well, this is what you can do. You can write or call the state of California. You can tell them this particular tax year, you did have a license. It was an active license. However, you didn't generate any income because of your medical situation. And then, of course, maybe the state of California is going to look for some documents. But the bottom line is when you get that notice of proposed assessment, respond to it. If you don't respond to it, then it becomes an assessment. And now you have the state of California trying to collect tax from you, and then becomes very, very frustrating. And then time and money is involved. So you have to address these things. Your client wants to address these things when they receive it. But again, you're going to point the way, not advocate. And then I get clients all the time. I didn't prepare the return, and I get a call or they visit my office and they go, Jerry, what do I do? We read the notice together, and then I said, okay, this is the action that the state of California wants you to take, and so you have some options. You can ignore it. You can respond to it. I can respond on your behalf, whatever the case is. But again, the bottom line is if they get a notice of proposed assessment, respond to the notice. And if you need help, then that low income tax clinic is available. If you choose to hire a practitioner, you can go out in town and find one and they can help you out. And then as far as other items of education, we do know that the Franchise Tax Board or California, they don't have what is called a tax court. The federal government does. And you can go ahead and slug it out with the federal government and tax court, and that's a civil court. California doesn't have a tax court, but they do have an appeals process. And at the end of the day, you can go all the way into the California Superior Court. We don't do that obviously for the client, but these are educational tools for the clients if they choose to bounce all the way up to California Superior Court. Typically, what happens is if it's a lot of money, usually they're going to go to that low income tax clinic, or they may hire a an attorney to help them slug it out with the state of California in a California court. Okay, and then court ordered debt. This is something that you see a lot of, and for various reasons, people owe California, and sometimes they owe California because they ignore the notices, or sometimes they owe California because, well, they know they owe it, but they just either choose not to pay or they cannot pay. And so when you have court ordered debt, what happens is the Franchise Tax Board, they're the folks that are going to collect court ordered debt. So think of I've been in court for traffic tickets, and the judge says, okay, you owe 50 bucks and a court filing or court fee of maybe, I don't know, $100 or something like that. Well, in California, that court ordered debt is collected by Franchise Tax Board. And so it can confuse people because they go, well, I don't owe anything to California, but I'm getting these notices from California FTB. Well, that's court ordered debt. And the bottom line is when a judge says you owe this, then you have either to pay it or you go back into court and say, hey, judge, I'm indigent. I don't have anything. I can't pay it. Sometimes the judge then will go ahead and reduce the amount, or in some cases, eliminate the amount. But if you have court ordered debt, FTB is your agency that's going to collect it. And so at the very bottom of the screen, and this is something that happens a lot, individuals receive a garnishment on their paycheck, and that hits home very quickly. Well, if there's a garnishment, again, you can go to the FTB and say, hey, I've got extenuating circumstances, and i.e. financial hardship. And so sometimes the FTB will work with you on that. But one thing you don't want to do in California, if you've got court ordered debt, or for that matter, a tax that you owe the Franchise Tax Board, you don't want to ignore it because the FTB is not going to forget about it. They got a long time to collect. And then one mechanism is that wage garnishment. Now, when you hear the term lien and levy, lien is a notice, levy is the taking. And the FTB, it's been my experience, they're highly experienced and they're very efficient at garnishing paychecks. I think they're better than the IRS. And so you may bump into that when someone says, hey, what do I do? Again, you can educate them, not advocate, and say, well, you've got some options. Again, you can ignore it or you can contact the FTB. And if it's significant or the individual has a very complex situation, the low income tax clinic in Santa Ana, that might be a go-to solution for the taxpayer. All right, Robert, I'm going to hesitate and see if you got any questions. I don't hear
I
any,
think we're
so
good, Jerry.
okay. All right, we're going to move on. Okay, so what we'll do, leave this up for a while. If you choose to jump into the 2025 software, you can go ahead and complete as much as you can before we come back from our break, and then we'll talk about the Gina Rista. This is different than the Gina Rista that we had last week because in this case she is single. She works at a different job, and then she has certain expenses to include. You might remember our discussion covered California. And just a quick reminder for Covered California, she is in the program and she was issued a 1095-A. And we'll show you how easy it is to report this on the federal side of the house for Covered California. And keep in mind, Covered California, the individuals pay a premium and then they are subsidized by the taxpayers. And so what happens is if the subsidy is too little, then they're going to get the premium tax credit on their federal return. If the subsidy is too much, then they have to pay that excess back, and that would be on their federal tax return. And then the rest of the scenario, pretty self-explanatory. You probably have bumped into most of these topics before. And then I will mention something at the very bottom. This is part of the fact pattern. She purchased shares in a corporation. She purchased shares in a corporation. It doesn't say anything about disposing or selling shares in the corporation. And so I will leave that up for a while. And then when we come back, I've got 11:53. Let's come back at 11:05, and then we'll talk about Gina Rista.
Can you guys see it?
Okay. Can everybody see it? I can see it, Robert, so I
I
think we're
can
good
see
to
it.
go.
Yep, everybody should see it.
Okay, if you can drive and I'll give you instructions and let's
Yes.
go ahead and drive. So if you would, Robert, have you entered any data regarding 2025 yet?
Oh, this
This
is
is
mine,
actually
Jerry.
Ashley.
It's
Yeah,
gonna be
so go
me.
ahead
Oh,
and
Ashley? Okay, are you going to drive, Ashley?
yep.
Yeah, I'm gonna drive. I don't
Okay,
have any new returns, or I don't have any,
no
I don't think.
worries. So let's do this nice and
I have a
slow.
practice one.
Oh, okay, that'll work. Let's go ahead and hit select. And then
Okay.
let's talk about this, and so we can get something out of this. We're going to go to a return. And then Ashley, if you would go to the very beginning on your left-hand side, and let's go to basic information. Let's review a few things. We're going to go to filing status, and we're going to have a single taxpayer. Okay, great. And then we're going to hit continue. And just a quick reminder, that means your your marital status at the end of 2025. Okay, we've got the name of a taxpayer. That's good. And we're going to cursor down, and we're going to stop about right there. And just a quick reminder, you've got a lot of boxes that you probably won't use in the VITA program. You may see a couple of these. You may see taxpayers blind. That's a tax definition of blindness found in your publication 17. That's an additional deduction for your taxpayer. You might have a taxpayer who comes in and they've announced that they've lost their spouse. And so we'd indicate a decedent and then of course the date of death. And then a lot of times you got your $3 to the presidential election campaign fund. Okay, so we got that. Let's go down and hit continue. And then we're going to go to, in this case, we've got no dependents, so we're going to leave that alone. And we're going to hit, quick reminder, the IRS Identity Protection Personal Identification Number. That means the taxpayer brings in a document that they've received from the IRS, which means we can electronically file the return, even though the Social Security number has been compromised. Okay, we'll hit continue. And then we're going to go to the Form W-2. And we're going to go ahead and open up the W-2. And we're just going to point out a few things here. So we've got a standard W-2. That's typically what you're going to see with your taxpayer. If the taxpayer has an amended or a corrected W-2, they're going to bring that in, but typically it'd be the standard W-2. Substitute W-2 simply means the individual has a year-end statement with cumulative information to include federal and state taxes paid and along with the income. Okay, so we have an employer here, and we're kind of working this on the fly because this is a different one, but we'll get some information out of it. If we go to the right-hand side, that's our taxpayer. We're good to go there. We're going to go all the way down to the income slide. And then what Ashley is going to do, Ashley, change that to 40,000 in box 1. And then if you would change the tax withholding, federal tax withholding to a total of 1,000. And then we're going to go to box 2 and I stand corrected, box 3 and 5, we're going to change that to 40,000. And so what that means is this taxpayer does not have any tax deferred savings program. If they did, like a 401k, would have a different amount in box 1 or box 3. We're going to change box 5 to also 40,000. And then you can see box 4 and box 6 auto-populate. And typically, most people pay into Social Security, but not everybody. And when you do see someone who has not paid into Social Security, that means they're in typically some other type of savings plan. Okay, so we're going to cursor down to where it says retirement plan. We're going to go ahead and uncheck that. And then we have the D, that's deferred compensation. We're going to make that go away. But just a quick point here, in the VITA program, you're typically going to use D for deferred compensation and DD for health insurance paid by the employer for the employee. So we're going to make that go away. So just go to the top and hit select. There you go. And then box 14, in our scenario, we've got some state disability insurance. We're going to click there and indicate that. State disability insurance is a tax. Oh, $150 on that also, Ashley. STI is a tax. It'll roll over to the Schedule A as an alpha. Okay, we're going to go down to California. We're going to indicate California, total wages of 40,000. And then our state tax withheld for California is 70,000. I stand corrected, 700, 700. Okay, and we mentioned before box 18, 19, and 20. We don't use that in the VITA program in California. Okay, we're going to hit continue. And then that is our dashboard. And sometimes you have a second W-2, and that'll be indicated by yes, add W-2 if we had a second W-2. Okay, we're going to hit continue. And we're going to go to interest and dividend. And in our scenario, we did not have any interest in dividends. So yeah, Ashley's going to go to the 1099 INT. We're going to open up that tab where it says add edit. Talk about this real quick before we delete all this. Interest income is paid by a bank or a financial institution, credit union, and these are monies on deposit. And typically you're going to be issued a 1099 INT. If you have dividend income, you're going to be issued a 1099 DIV. And if you are in a program that's called a dividend reinvestment program, that means you have constructive receipt of income, which means you're going to be issued a 1099 DIV and you're going to enter the data. In this case, our taxpayer has neither. So Ashley's going to hit the red garbage can icon and make it go away. Just that particular entry. Good. And then that one too. Okay. And then she's going to hit continue. And we don't have a Schedule C, so Ashley's going to hit continue, and she's going to bring up the Schedule C on the left-hand side, far left, and she's going to go up to the Schedule C. And you might remember our discussion about the Schedule C. Here's our dashboard. And all you got to remember is what are total gross receipts. Sometimes it's evidenced by a 1099 NEC, sometimes it's not. But in your interview process, you're going to determine what's the total gross receipt for this taxpayer. And then expenses, we typically use the term ordinary and necessary. And is it reasonable in amount? And is there a business purpose? So there's our dashboard. We're going to make that go away too. We're going to hit that little red garbage can icon. Okay, and then let's go to capital gains. We'll open that up. In our scenario, we had the situation where the taxpayer purchased shares in a corporation but did not sell any shares. And so when you purchase shares in a corporation, then of course you're a shareholder, stockholder, and you're not going to report any gain or loss unless you sell those shares. And so we're going to go ahead and delete these two. Hopefully it's not goofing up your system there, Ashley, but we're going to make those go away.
It's
And
fine.
we'll
I need
make
to
that.
practice again anyways.
Oh, there you go. There you go. And then, of course, it's really important when you have someone who says, hey, I bought shares in a corporation, then it might beg the question, okay, then did you receive any type of dividends? And if you receive dividends, then your dividends are going to be reported on your return. But typically you see the dividends 1099 DIV, and sometimes that DIV will be built in to the 1099B as in Bravo. Okay, we're going to hit continue, and we've made all of that go away. And then we're going to go to the left-hand side, and we're going to start at the top. We've got our wages in there, and we're going to go ahead and go to the itemized deductions. Have you created that yet? And hit deductions. It'll bring up the itemized deduction, and we're going to go to that. And before we get into any tabs, we have our various items to include our medical. We've talked about this. We got your interest you pay, your mortgage company, taxes you paid, maybe property taxes, gifts to charity. Gifts to charity is a big thing. Thankfully, that's a big thing. A lot of people are very generous. They donate money to a qualified charitable organization. And in this case, our taxpayer did just that. So we'll open up charity. And she donated a total of $3,700 to a qualified charitable organization. So we're going to go to cash gifts. And we're going to indicate the name of the qualified charitable organization, Feed Me. And then our description is going to be cash. And typically that's what you're going to see when someone donates to a food pantry and they're donating food, then that would be a non-cash charitable contribution. The date, we only have one choice, so we put down July 5th. I stand corrected. We put down, let's see if we had a date here. Let me look at my scenario. Here we go. June 1st. And then this begs the question, what happens if you have a taxpayer who's donated money throughout the year? Well, because this software only gives you one choice, that's the only game in town, you just pick a date. In this case, it's $3,700. And then we're going to hit continue and stay in the itemized deductions. So we'll hit continue again. And don't do anything, Ashley. So the non-cash gifts, that would be if you're donating, let's say, canned goods to a pantry, or let's say you donate a refrigerator to Goodwill, something like that. Then you have to get information, obviously, regarding that non-cash gift donation. And there's a limitation in the VITA program. That's where that would go. Now what we're going to do, we're going to go ahead and hit continue and go to our itemized deductions. So we're going to cursor down a little bit. And we're going to go to our unreimbursed employee business expenses. And we're going to look at this real quick. And so we have union or professional dues, job search, uniforms, things like that. You cannot deduct this on your federal return, but this is the place where you're going to deduct this or enter this so it's deducted on your California return. So we're going to go to union and professional dues, and our taxpayer paid her teacher's union $400. And so what that means is once Ashley hits continue, if we had a state return, it would generate on your itemized deductions for California. So this is where you would go to enter your data. And if you had information, cursor down a little bit, if you would, Ashley. If you had information regarding perhaps maybe someone has incurred expenses for tools or maybe even uniforms. So uniforms is something that you can deduct in your California return. So let's say you have a registered nurse, and let's say the registered nurse paid maybe $500 for their uniform. This is something that can be deducted on a California return. Okay, we're going to hit continue. We're done with our Schedule A itemized deductions. And now we're going to go, we're going to get out of this and we're going to go to our educator expense. And so what Ashley's going to do, she's going to go to adjustments on the very top. And then we have a lot of different types of adjustments. Typically, you'll only use a couple of these in the VITA program. She'll click on educator. And then keep in mind the educator expense for tax year 2025, it's going to be for someone who's worked 900 hours in the school per year, and they are either K through 12. So if you have someone who's a college instructor and they pull money out of their pocket for the students, doesn't count. It has to be K, kindergarten through 12. In this case, she pulls out 650 bucks out of her pocket. She's only allowed 300, so we're going to type in 300. And if our taxpayer was married filing joint and both of them were educators, then we'd get a total of course, the software would show a one for each. And so that would be a total of 600 for a married filing joint. Let's hit continue. Okay, and then we're going to go to our tuition. And so what we're going to, well, actually, let's do this, Ashley. Let's go to the student loan interest. Let's take care of that. And that would be toward the bottom of that screen. This is an easy one. The max is $2,500. And in our case, we have a total of $2,500 that Jean paid. And so we'll enter that. And we'll hit continue. Okay, and then our next topic is going to be she's going to school. And so we're going to go to our deductions again. And we're going to go to our credits. And then Ashley's already entered data in regarding our education credits. We'll click on that. And then we'll open it up and talk about that a little bit. And so for education credits, there's two different types, the American Opportunity Tax Credit and the Lifetime Learning Credit. And so this is really important. We have a lot of young taxpayers who are going to college. So when they bring in that 1098-T, that's your go-to document. And then you want to make sure you ask about textbooks because textbooks out-of-pocket expense are part of that qualified education expense. Okay, so we go to the screen. And the first question is, did they receive the 1098-T for 2025? They did. And they did not receive one for 2024. So we'll hit continue. And then it has information pertaining to the school. So we got the college information there. Okay. And we hit continue. Now this is the portion of the software you're going to slow down a little bit. You're going to determine total tuition paid. And in this case, for our taxpayer, we're going to look at the fact pattern. She paid $2,000. And then just a reminder, she attended less than half time. So that means we're going to default to the lifetime learning credit. She didn't have any felony drug convictions. And then she received a grant for $500. So we're going to plug that in. And typically the grants and scholarships are going to be reflected on the 1098-T. And then in our scenario, she paid $200 for books. And so we're going to plug that in. And then just a quick reminder, a lot of times your taxpayers will have information on an electronic device, and that's acceptable. And so, as I mentioned before, we ask about books. Sometimes they turn that device toward the preparer and say, here's my receipt. And that's acceptable. Sometimes they'll have pieces of paper, sometimes they'll have it on an electronic device, however they have it. And so now we've entered our data, our tuition that's paid out of pocket, our grant that she received, and then her other qualified expenses, which would be books. And then just a quick aside, if you have a parking pass, your parking pass is not included in qualified educational expenses. Room and board's not included. And so you're going to get a little pushback from your taxpayer, and you just tell them that's not part of education expenses as part as far as computing the credit. Okay, and then Ashley, hit continue. And that takes care of our education expense, and she'll hit continue again. And well, yeah, she's already answered this real quick. We talked about this, but we'll just quick review. It says, has the American Opportunity Tax Credit or the former Hope Credit been claimed? In her particular case, yes. Our fact pattern says she's got a master's degree. She already went to school. She already used the American Opportunity Tax Credit. That Hope Credit, it existed a number of years ago. So you may have a client who went to college 15, 20 years ago, and they took the Hope credit. So you want to determine, did they use 4 years of either the Hope and or American Opportunity Credit? In this case, it's yes. And then down here, did she enroll at least half time? The answer is no. The school's going to determine that. So we're good to go there. The next question is, did the student complete the first 4 years of higher education before our tax year? The answer is yes. And then the question about the felony drug conviction, and the answer is no. And that's a sensitive question, but you have to ask it. It's part of the tax law. And if they say yes, then just indicate yes. But generally, it's going to be no. Okay. And then this is where your dashboard shows you our taxpayers entitled to the lifetime learning credit. And keep in mind, the lifetime learning credit, the total amount is going to be allowed per return of $2,000. That's the total amount on the lifetime learning credit. And so again, even though she paid $2,000 for her tuition, it's used to compute the credit along with the books. And then you have to account for the grant or the scholarship. Okay, so we're done with that. We're going to click there. And then we're going to go ahead, and that's our summary. Now, here's another thing. You may have 2 or 3 adult students on the return. Maybe mom and dad have children 18, 19, and 20. They're all going to college. And so you might have 1 or 2 that are eligible for the American Opportunity Tax Credit, and then maybe one that's eligible for the Lifetime Learning Credit. So you just enter it for each student. Okay, we're going to hit continue. And then let's see, this is uncharted waters here. We're going to go, Ashley, to tax on early distribution. We're going to open that up. That'll be on your left-hand side. Now, you've already entered data for a taxpayer, but what we're going to do, we're going to talk about this, and then we're going to make it go away. When you have someone who takes a distribution from like a 401k, if they're under 59 and a half and they don't meet one of the exceptions, then what happens is, well, first of all, they have to pay income tax on that distribution because it's a tax deferred program. And then they may pay a penalty, a federal penalty of 10%, a state penalty of 2.5%. And so it can be very expensive money. So if someone has a distribution, they're going to have a 1099-R, you're going to enter it in the system, and you're going to determine if they're subject to a penalty. In this case, we don't have this in the fact pattern. We're going to make this go away. Okay. And then we're going to open up retirement income and talk about it. And so retirement income, there's different types. 1099-R, it may be for someone who's 35 years of age. It may be someone who receives a pension and they're 70 years of age. And so the 1099-R, generally you're going to have a fully taxable amount. If you have someone who has basis in their pension, and you may see that from time to time, we use the simplified method. Ashley, can you open this up? And can you just cursor down just a little bit? And you're going to see where it says the gross amount, in this case, 5,000, the taxable amount. And so go ahead and click where it says, okay, you got taxable amount not determined. Let's go ahead and click here for options. And then we'll slow down just a little bit. And so if you have someone who has cost or basis in their pension, you're going to use the simplified method worksheet. And if you can click on that, Ashley, it's going to give you the details regarding this. And we're going to click continue. And then this is where you have that interaction between the preparer and the taxpayer. So the taxpayer has certain information that they're going to provide the preparer. When did the plan annuity start? Meaning, when did they start receiving the pension payments? What was the cost of the pension when they started the plan? Basically, their basis or adjusted basis in the pension. Let's see, cursor down a little bit. Ages, if it was married filing joint return, then you have to add the ages of both the taxpayer and taxpayer spouse. And then number of months paid in 2025. That's pretty easy. The taxpayer is going to have a 1099-R and they're going to say, I started getting my pension payments, let's say March 1st. And so now you'd have a total of 10 payments for 2025. And this is something that you're going to see once in a while. It's up to the client. You got to get the information from the client. Amounts previously recovered. And so I use me as an example. I'm a retiree of the IRS. I had basis in my pension. So every year, what I'm doing, I'm recovering a portion of my basis. And I have data in my software, I have data in my records of all of the amount that I've recovered of my basis. If your client doesn't know amount previously recovered, then they have to contact the trust administrator to determine how much they recovered. If not, then we're going to leave that blank and the taxpayer is going to be at a disadvantage tax-wise. And so they got to collect the data from the trust administrator, which usually they do because the administrator, that's their job. Okay, we're going to get out of this, Ashley, and then make it go away. So we'll hit continue and then bring up hit continue, bring up the little icon. Yeah, just hit continue. There we go. And we're going to make that go away. All right. Okay, so go back to our scenario. We've entered data regarding the W-2 income, information regarding her school supplies she bought for the kids. We got the information regarding the school that she went to. We got the information regarding the student loan interest she paid. We have the information regarding her contribution to her qualified charitable organization. Quick reminder, when you donate money to an organization, it has to be qualified. If you're unsure whether or not it's qualified or not, there's a search tool in the IRS website where you can go ahead and indicate whether or not it's a qualified organization. There are some organizations, and maybe they do good things, but they're not qualified. In order to be qualified, you have to request, you have to fill out some paperwork, send it to the IRS, and you have to request a determination. Okay, let's see. Let's go to what else do we have here? I think the NEC. Let's open that up. Just a quick reminder, when you are a non-employee, that means you're going to fill out a Schedule C as in Charlie. Sometimes you're going to be issued a 1099 NEC, and then this is where you'll enter the data for someone who receives a 1099 NEC. And then what happens is it's part of, or it could evidence the entire amount of the gross receipts. And so that's what an NEC is used for. But if someone just puts an NEC in front of your face and say, this is what I received, it begs the question does this evidence all of your gross receipts? If it does not, then tell me about your gross receipts. And then keep in mind in the VITA program, we only work with cash method taxpayers. And then Robert knows this. He's going to run his site on Saturdays. Robert, is it mostly Saturdays or are you going to be there other days?
We are running on Saturday, and then we're also going to be operating Tuesday nights.
Okay. And then you have some highly experienced people there, so they're going to be able to figure this out and help out the junior folks. And then if need be, if you need to bounce a question to me, you text me or call me and I'll usually pick up my phone. Okay, so Ashley is going to make this one go away because we don't have a Schedule C in our scenario. Okay, then we've got to address the covered California situation. So Ashley's going to go down to health insurance. And then this is non-negotiable. If someone is in covered California, that means we need the 1095A as an alpha. And this is what I do at my site. I try to help people out as much as I can because, people they've been very generous to me over the years. And so when someone comes in, they don't have the 1095A, we explain this is something we need to complete the return, give the individual an opportunity to go back and get it, or maybe go on Covered California and download it. But give them a chance to bring it back maybe that evening or maybe the next week, and then you can help them out. But the 1095 is going to be issued to individuals in Covered California. And so in this case, they are in the Affordable Care Act. So we're going to say yes. And then we hit continue. And then what will happen, you're going to go through these screens. The first screen talks about your so-called tax family or tax household. In this case, it's just one taxpayer, so that makes it easy. Hit continue. And then we answer these questions, and this is the typical answer you're going to give in these particular scenarios. The first question talks about allocating the policy. The answer is going to be none of the above. The next question is, are you required to repay all of the advanced premium tax credit? And the answer is going to be typically no. And then the next question, it says, does the Form 1095A, and that's an IRS form, include coverage for January through December with no changes? And so that means the bottom line in column 33A, 33B, and 33C are all the same. And if that's the case, you're going to hit yes. And that's what we have in our scenario. It talks about the advanced premium tax credit. So what that means is the taxpayers receiving subsidies from the taxpayers to help pay for the insurance. That's the whole concept behind that portion of the Affordable Care Act, helping people get health insurance so they can go to the doctor and they're covered. Okay, in this case, the scenario said that we had $2,700 in 33 Alpha, 33 Bravo, and 33 Charlie. And then we're going to hit continue. And then, yes, the state's not available, work in progress. And so we're going to hit continue on that. Now, before we do this, I think we have a couple minutes. We're going to visit this real quick to kind of refresh your memory. So Ashley, if you can go to the left-hand side of the screen, and if you can go to the federal section, and let's go ahead and go down to the deductions on the left-hand side of the screen. And then what we're going to do, we're going to go to the additional deductions tab. And then just a quick reminder, you might remember this the first time we talked about this a few weeks ago. You're going to have taxpayers, and you're going to see this on a lot of returns, where a portion of their overtime is not subject to federal taxation, where a portion of their tips are not subject to federal taxation, where they purchased a new automobile and they can take a deduction for that new automobile on their federal return. Now, the senior, what is called the senior deduction, that additional 6,000, that's automatic. You don't have to worry about that on the federal one. But here are the tabs that you're going to go to. So Ashley, if you can open up the overtime tab. And what's going to happen, maybe not on all W-2s, but you should have some type of documentation the taxpayer is going to bring in, and they're going to say, I had overtime and my qualified overtime was X number of dollars. This is where you would go to enter that qualified overtime. And again, this is on the federal side of the house. The state of California does not conform to that. And so you're not going to worry about that on California. Or stated differently, if California has that automatic adjustment, then it's that you're going to have a subtraction on California. You don't have to make any changes. We will talk about this next week because we're going to have the California software ready to go. But again, this is where you would go for no tax and overtime. Hit cancel if you would, please. And we're not going to open this up, but again, tips, qualifying tips, no tax on tips, and then your car loan. When someone has a new car that they've purchased in 2025, they're going to have information to include the vehicle identification number, and you're going to use that. We will talk about these tabs because, again, the California software is going to come out tomorrow, the next day. Okay, so Ashley, let's do this. Let's go ahead and I think if we hit preview the return, I don't think we can see it. So let's go down to our summary print. Click on that. And then what you'll do is go ahead and enlarge your screen here so we can look at the 1040. Okay, we got a few minutes here, so let's talk about this. This is your 1040. Most of us are very familiar with the 1040. It's changed a little bit in 2025. So we have administrative data at the very top. Cursor down a little bit. You're going to see in the middle where it says digital assets. If the taxpayer has purchased cryptocurrency, we can help them out if they're within the VITA qualifying qualifiers. If they've disposed of or sold digital assets, that's outside the scope. We can't help them out. Then we cursor down a little bit. We have no dependent here, but you can see that's changed a little bit. And then we go to box 1 alpha, and that's your wages or W-2 wages. That carries all the way down to box 1 Z as in Zulu, 40,000. We cursor all the way down. We have adjustments to income. Talk about that in a second. And then we have our AGI. So when you hear the term AGI, that's total income less your adjustments to income. And then Ashley, click on 2. Go to the top of the screen, and we're going to see our AGI reflected here, a little over $37,000. And then we see on line 14, that is the same as the amount as line 12E, and that is our standard deduction. If you go to the left-hand side of the screen, this is the standard deduction for most individuals. If you have a blind individual, they're going to have a greater standard deduction. If you have a senior, you'll have a greater standard deduction. This is for most individuals. And so we know if you take your AGI less your standard deduction, then you're going to end up with your taxable income, which is line 15. And then we have our federal income tax on line 16, that's reflected there. And then we have some of these what are called non-refundable credits. And then we also have what is called the excess payment, which we're going to get to. And so our bottom line is line 24. This is our total tax. Most taxpayers are interested in, do they get a refund or do they owe? So this is a work in progress. This is the amount of her tax. Let's see what she's paid in. So we go to our withholding of 1,000 on line 25 alpha, and that's it. And so you take 2974 minus 1,000, that's going to give you the difference at the very bottom, which will be 1974. Keep in mind, we do not calculate any penalties on what is called the estimated tax penalty. So what happens is the taxpayer owes this, they'll pay it somehow, and they may get a follow-up letter from the IRS. Okay, Ashley, if you go to page number 3 and go to the top, and let's take a look at this again. Additional income is page 1, or schedule 1, page 1. Adjustments to income is going to be schedule 1, page 2. So we're going to look at this particular schedule, and let's see if we see any numbers here. We're going to cursor down. And nothing there, but we're going to go to page 2 of schedule 1, which is the 4th item. We'll cursor up and we'll see if we see something here. And we do. Educator expense. And that's an adjustment to income. And we've got our student loan interest deduction. That is an adjustment to income. Okay, so that's that. You might see on this particular screen for your client, maybe they've relinquished their jury duty check to their employer. You might have what is called a deduction for IRA, but this is where your adjustments to income go. Okay, we're going to go to the next page, which is page, cursor up, keep going. There you go, page 6. Okay, and other taxes, let's go ahead and cursor down here and see if we've got anything. Okay, we're good to go there. We're going to go to page 7, and then we're going to show you the one you may see, which is going to be a shocker for some of your taxpayers. We're going to cursor all the way up, and this is called your additional credits and payments. And your additional credits and payments, this is the education credit that she is entitled to because she went to college. And make sure you determine the amount of the out-of-pocket expense to include books, and then you account for the grants or the scholarships they receive. And typically, other than the books, your grant scholarship and your tuition is going to be reflected on your 1098T. Let's see, we're going to cursor down and see if we've got anything else. I see nothing else. I think that's it then. Okay, so hopefully we didn't miss anything. And I think we're in within our allocated time. So Robert, let's do this. Let's open it up to any questions. We got about 5 minutes. And before we finish things, just a couple of pointers. Next week, we're going to talk about finishing the return. We're going to go through a couple of scenarios. We're going to have the California software. And if the 2025 is not up for some reason, we're going to default to 2024 so we can navigate through a California return. But we're going to go through a couple scenarios and then again, finishing the return. So thank you, Ashley. If we can go back to Robert and see if we got any questions.
We have a couple of questions. Back to
Okay.
the step up in basis. If the spouse dies and many years go by before you sell the house, how do you come up with the cost basis with the
Yeah, and
step up in
you do
basis?
have that from time to time. Someone will lose their spouse, and they may not be aware of that step up in basis, and so 5 or 10 years later, they're getting ready to sell their house, and they're trying to determine their gain. So what you have to do, it becomes a little bit of a workout. You have to go ahead and do your 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 best estimate, if you will. This is how I do it in my practice. I actually had a case like this a couple months ago. Individual didn't know, says, "All right, let's go back and let's talk to a real estate broker in the area, and let's determine you got a zip code, you've got square footage of the house, and what were these homes selling for in reasonable condition back in 2000 and 15, something like that. So your best estimate, because you don't have an appraisal. An appraisal is the gold standard, so you've got to rely on a best estimate, and that's probably the best answer I can give you.
All right, we have a question about a CD. It says, do we report interest earned on CDs if one rolls it over to a new CD?
The short answer is yes, because when you purchase a certificate of deposit, what you're doing is you have paid income tax on the monies that you put on deposit with the bank. You sign a contract with the bank, and then of course what happens is the principal is there, you're earning interest, and then let's say your CD comes to maturity after a year, then you withdraw your CD, you withdraw the principal, you withdraw the interest, and then you, let's say, buy another CD. So yes, you would report that interest that you received on your CD.
And are commission fees deductible on capital gains?
Your commission fees let me put it the best way. Typically, what happens is That's going to be reflected in the 1099-B as far as your proceeds. And so the short answer is yes, you're going to take a tax benefit for commissions paid because it'd be reflected in the proceeds.
Another question is, if I sold shares and lost money, is there income tax to be reported?
If you sold shares and you had a capital loss, then what you can do, you would file a return. You would enjoy a certain amount of that capital loss, and that capital loss you can enjoy is $3,000 per year. The remainder of that loss is carried forward to the next tax year, and you keep carrying that loss forward until you use it up or you expire.
And then someone wants to know, what are the three different types of taxpayers? You said it was wage earner, investor, and what was the third?
Yeah, your three types of taxpayers would be an investor, a wage earner, and a self-employed individual. And so, really, those are the only types you have. In the VITA program, you'll have a lot of W-2 employees. You'll have some self-employed individuals, like, for example, an Uber driver, a Lyft driver, or maybe a dog walker. And then your investors would be individuals who are purchasing mutual fund shares, shares in a corporation, things like that.
And do students need to have the receipts for the textbooks in order to claim the educational credits?
This is what a student should be able to do. They should be able to show you that they've expended monies for a textbook. So the gold standard would be some type of receipt, electronic or hard copy. Now, what I've done at my Vita site, I'll ask them questions. I'll ask them, what school did you go to? What textbooks did you buy? And how much did those books cost? And so for lack of a better term, would I accept oral testimony? Sure. If they say, yes, I bought an accounting book, a financial accounting book, it cost me $250. I used it at Coastline College for my introductory and advanced accounting, then that's good enough for jury.
And then on the Hope credit, if the taxpayer doesn't remember if they used the credit, is there a way for them to find out?
There is a way to find out, but it's a little bit of a workout. You'd have to contact the IRS. You can go back a number of years. I think the most years I've gone back with the IRS is 30 years, 30. And so you can go back, but it's a matter of requesting that. You do not have to pay for transcripts, but if you want a copy of a tax return you filed, you do have to pay a fee for that going back a number of years, but you can get transcripts for free.
Okay. We're gonna I'm gonna open up the mute, and if anybody has any additional questions that they would like to ask, they can stay and ask. If Jerry, do you have the time to stay and answer additional questions?
Sure. Even though Robert, the Army Navy game has started, I am here for our volunteers for the next 5 minutes.
Okay, then let's do that. We're going to enable. Okay, hold on. Unmute themselves. And I think anyone want to unmute themselves and ask a question, go right ahead.
I have a
Right.
question. Oh, so for the,
You go
I,
ahead.
okay, sorry, thank you. My question on the step up in cost basis, was if the surviving spouse sells the house later on in time and there's a profit, like example, 100,000, she would not have to pay taxes because she's still entitled to the 250,000 exclusion for capital gains for owning the home as the primary residence. Like she's
Oh, that's
still
correct.
entitled to that.
That's correct. If you
Okay.
meet what is called the exclusion amount, then in that particular scenario, then she would not have to pay any capital gains tax. Now, what she would do to make sure she's going to get that exclusion, she would file a tax return, and it would show that she has no gain. But you got to file a return to take the exclusion.
Okay. Thank you.
He's asking how many years back does the credits can you use?
Yeah, you can go back. Let's say in 2025 you realize, hey, I did not claim a credit in 2024 or 2023, then you can file an amended return to claim those credits.
How
Okay,
far
all right.
back, though, is the question? How many years back?
Well, as far as the statute would be open, so typically, like right now, you can go back to tax year 2022.
All right, thank you.
Sure.
I have a question regarding, and this is actually something I meant to ask last week or 2 weeks ago, whichever it was, regarding people who have donations to what they believe is an actual nonprofit, tax wise. Um, if we try to explain to them that they donated to a non-tax exempt program, right? So it's not actually a nonprofit or whatever it is, and they get a little irate about it. Is there anything that you would recommend us do in those situations?
Yeah, and I recognize, I mean, everybody gets frustrated when you're talking about money because, this affects people who are low income and moderate income. But the bottom line is you explain or you educate them and say this particular deduction is not a deduction you can take because you have not made a contribution to a qualified charitable organization. And what I would do, of course, time permitting, I got that. I would show them the IRS search tool for nonprofits and say, okay, we've entered the information pertaining to the organization you donated to, and they do not appear in the IRS search tool. So that means it's not qualifying. So you can't take the deduction. And it's a hard pill, but that's basically it.